Most of the people who start day trading will lose money and quit within the first few months. That's not me exaggerating things. It's the single most important thing one needs to understand before they risk their money and place a trade. But no one tells you this, that all the ones who failed almost failed for the same exact couple of reasons, and each and every one of them is avoidable. So, in this video, I'm going to tell you two things. I'm going to tell you exactly why beginner day traders fail, and the second thing, I'm going to tell you exactly how to avoid those traps and place a trade with the right mindset in mind starting from zero. So, let's get into it. This is the number one killer. The people who started day trading just after a couple of few good trades think they are right about the market all the time, and they start to take oversized positions which they can't afford to lose. And then what happens? Then they will lose their trades and all the profits which they made across all the previous weeks with just one to two bad trades. And without a proper exit strategy, they refuse to exit a trade even though it's going against their interest and expect the price to reverse just so they can satisfy their ego. So ultimately what happens is that kills their account and make them quit, thinking it's just a gambling, while all the while he's the one who is trying to predict the market and dictate it. Emotion trading. This is one of the hardest trading psychology to master, even for the mid-level traders. Because when you're in a trade, there are like hundreds of conflicting thoughts reacting to each and every single second take for you to make decisions like profit anxiety. Fear makes you exit winning trades early as your mind convinces you to make uh, uh, the exit as thinking the market will crash, and loss denial. Staying in a losing trade because your mind creates an illusion that the market's going to reverse and makes you profitable just to satisfy your desires. And distorting the real market data to hear what you want instead of what is actually happening is what the mind does, is what the emotional trading is. No edge and no tested strategy. Most of the beginner day traders actually don't have a strategy. They blindly take a trades by watching some of the online videos and test just a couple of times. And once they see their losses, and they say that no, that strategy is not working, and they switch to a different one. Trading blindly without knowing if your strategy has a strategically proven positive expectancy over time or not is one of the things to consider in mind. And abandoning a strategy only after a few attempts, and if you get a loss at that point, you will just decide that the strategy is not going to work instead of testing that on a large, a few days of data, few months actually. Get rich quick. This is what the gurus in online say when they are trying to sell their strategy to you for whatever the money with a rented Lamborghinis, Porsches, and a villas, giving you an illusion of this is how it was supposed to be, and you have to get rich quick. They're like just now, like just tomorrow. So sadly, that is not the actual truth. You are literally competing with the thousands of institutional traders who have done their masters and their education in finance and have like literally years and decades of experience. If you have to make money in their way, you need to have a basic knowledge and the foundations. Thinking that you can outsmart the institutional algorithms and the global market structure traders without the zero foundational knowledge is a very disappointing thing, but it is true in most of the beginner traders. No practicing or no backtesting or paper trading, like risking real hard-earned money while you're still making rookie mistakes without actually testing the strategy in the back end or in the live paper trading, and go straight away to your money, giving your hard-earned money to do trade, expecting it to actually happen, like without you actually trusting it. It's you just want it to happen, and that's not the right mindset. And losing all the cash instantly because you do not know how to use that trading software or how it works yet. You just want to jump in. No, That's not the right way. Now, let's discuss how to avoid those mistakes as a beginner day trader and to place a trades with a proper risk management and rules so that we can make a better trade judgment while in the trading. So the first, let's start by understanding what is actually a day trading. So there are multiple types of trading. There's day trading, swing trading, and investing. So the day trading which we are focusing on this right now is mostly you held a trade from minutes to hours. And most of the times the trade is closed in the same day. So that is when you call it as a day trading. And the frequency you will, based on the probability, you will take two up to many trades a day. And the goal is to capture the intraday trend of the movement of the macro move. And it 95% on even mostly 100% of the time it depends on technical analysis, chart patterns, volume surges, and all that. And you will require very low capital and you can leverage a high accounts because you're opening and closing the trade in the same day. The leverage the broker gives you is higher compared to the swing trading and the investing. So let's discuss a little bit about swing trading and investing too. So swing trading is something you hold more than a day to a few weeks to, which capture a a macro move, a little longer move of the weekly trends. When let's say when there's a news like a quarterly report has been released for a stock, let's say Nvidia or Apple, then there's something about to happen in the market based on the news. So one analyzes the market previously and holds the trade till that goal is achieved, and which is driven by catalysts. So that is what is swing trading is, and you will as you, it's you are holding from days to weeks. The risk is moderate as there might be an overnight news and the price gaps, like without any trading session in between the nights with the off hours, the next opening session might be gapped up like a few percentages. So that is the drawback for swing trading. And the investing. Investing is something um, uh, like generally buying a stocks for literally months to hold over the years or sometimes not sell it. It's for a long-term mindset. So just and there's a quote in this saying, buy and hold. That's what the long-term investment is. You are actually investing in the company's business than just to make a short-term profit of the price movements. The risk management comes first. The one and most important role in the trading is the risk management. Because think of it as this, you have unlimited potential to profits. There is no cap to it, but you only have limited capital. Like the money you actually have right now is limited, but the money you can make is unlimited. So the risk you are willing to take should be based on that. So for example, here right here, if you have a 5,000 account, you should never risk more than 1 to 2% of your trade. That is a maximum of $50, $200 at max. That is per trade, not for the entire trading day, but the per trade. And you should be make sure once you place a trade, you are willing to let go of that $50 if it goes against you, because you're betting a trade because in that mindset, like with that intent in mind that you already lost that money, you are betting that money to trade to go against, like to go profit. So you should be willing to let go of that initial stop loss to make money. So this is a general trading anatomy. Let's say you enter at a position at here, then you should be there is a stop loss. You should place at a strategic point, and we'll discuss that in the later videos. But you should place a stop loss that's the maximum willing risk you're willing to take to get so and so or whatever reward. So without a stop loss, if the trade goes against you, you have like uncapped losses towards which goes against you and below the account. But when you have a stop loss, your only potential loss is still this because it will execute once it crosses this point, once it touches this price. So, but your reward is unlimited towards upside. So that is how you should be keeping your mindset. Your loss is limited, but your profit is unlimited. So you should cap your stop losses. So when you're wrong, you should be less wrong. And when you're right, you should be more right. So you have to decide the exit before you enter. The next one, start with a basic. Start learn how to read a basic candle pattern. Now, there are multiple price representations other than the candlestick patterns. We have like line patterns. Uh, we have like a number of patterns representation of price. But this is the most common and most informative representation of price, as this tells you four things at the same time. Open the where the price has opened in this given time frame. Let's say if it's a 5 minute, 15 minute, or 1 hour, the open price and the highest price where the price went is the top of the wick is the highest price, and the lowest price, the low of the wick, is the price where the went lower in that time frame. And where it closes, that's the end of the candle. Like the buyers and sellers fighter to push the price either down or up within that time frame. Do a paper trading on a live market before you actually risk your own money. Most of the brokers and almost all the brokers have the paper trading inbuilt in that in their platforms. So let's say suppose in here, so I have an option of paper trading. So I don't have to risk my own money. So this is the given amount. So this is virtual amount, which is not real, but the, the ones which you place and which you execute is real uh, because it's the virtual amount and the price, the execution is in real time. So you're actually simulating the live market with the fake money. It's because you will get to know the market structure. Let's say the price movement like this, if the actual paper trading, if directly went with your actual money, you don't know how to do. But once you get habituated to this, that's not the real money. But it's a good thing that you get to know the things before you actually execute and do with your actual money, and you will get the dynamics of the platform, and you will learn a lot in different cases situations while before you're risking your actual money. So it is always better to paper trade and back testing before going to live trading. Start with a simple setup. So before you enter a trade, you should decide where you are going to keep your stop loss, where you're going to exit your trade, where you are capping your stop loss, where you are capping your target. You should decide those before you actually enter a trade, because when you're in a trade like this, because a few below candles, like opposite candles, can make you shiver. Like, okay, why like the trade is going against my trend, so the trend is ended, and you will have like thousands of thoughts going on in your mind. So that is not healthy, and which that is what emotional trading, which we were discussing earlier, right? So just write a simple setup. So where I'm going to, what's the strategy, and where I'm going to enter, and where I'm going to exit, and there is nothing in between, either my profit or my stop loss, because you trusted your setup initially, and you have to see it through in through the end, not just shivering in the middle because of some opposite candles, because that will continue to make you a bad setup and lose your running profits, and will cost you a decision making, and you get into an unfiltered version of realistic timeline where you can start make money after these steps. So for the first 3 months, you will learn the chart reading, the chart patterns, the how to read a price, where price is going, and you will fix for a few strategies which suits you better, and you will start to paper trade. And in the next 4 to 6 months, you will go live trading with your real money or any prop from money or any challenge fees with a tiny sizes, small sizes, with the risk management tools which we were discussing earlier. Only risk 1 to 2% of the risk of your total entire size to keep and to the rules and become profitable. And for the next 6 to 12 months, learn from whatever the mistakes you made within the first 3 months or in the live trades, and refine that mistakes to adapt to it and make that less errors and keep it and aim for consistency. And after a year, you'll slowly start to see profits, and you can scale up from that. You can take more position sizings since you understand whatever the strategy you're doing and you are being consistent. And you can scale up to a higher level sizes and accounts. So the first few months are purely for learning and not for earning. So once you are comfortable with your strategy and you understand what is actually going in the market, then you can scale up to make an actual higher level of profits. So that's it for the video, guys. See you in the next one. Take care.